Good morning, everyone, and welcome to September's edition of my monthly market session. It looks like, okay, Temi will be hopping on momentarily and joining us. So I will wait to introduce her once she is here. I would love it if everyone could just throw their name and where they're joining from in the chat. If you're an agent, you can also indicate your brokerage. You can indicate which areas you're licensed in. And if there's anything in particular you would like to get out of today. Actually, hold on one moment. All right. So Temi will be on camera shortly. Today will be an interesting one. I am recovering from COVID, and my little daughter is recovering from COVID, which means I've also had no sleep. Temi is under the weather, but we are just going to be sitting here doing our best this morning. Good morning, Virginia. Great to have you on here as well. Grisel, hope I'm pronouncing that correctly. Great to have everyone here. Just introduce myself, and then Temi, if she pops on, can say hello as well. Paul Nalbandian, licensed in DC, Maryland, and Virginia. I'm a team leader with Fulcrum Residential. We are a team on Keller Williams Capital Properties, where I've proudly served on the Agent Leadership Council, going on my 6th year. Although with a new baby girl this year, I have not necessarily been contributing the most. Apologies, Virginia, but I will try to find more time for that going forward in the year. All right, Temi, here we go. I want to say hi to the folks. How are you doing this morning?
Much better, but my voice still isn't fully back, but much better. Yeah.
Yeah, I'll try to keep the coughing and sniffles to a minimum, but everybody just know, full disclosure. Luckily, that's the great thing about a live stream. We are not in person. No one can pick up my COVID or Temi's, whatever's going on. So I want to say hello to the folks. Temi, introduce yourself.
Oh,
If you'd
I'm
like.
Temi Paul Smiles Okoji. I'm with I'm a realtor with Keller Williams, assisting Paul this morning.
All right. Now, as tradition, I'm going to start off by introducing my coffee of the day. This is a wonderful Benjamin Paz Geisha, Benjamin Paz La Salsa farm in Honduras. This is black and white, black label coffee. Some incredible beans. Black and White is a wonderful roaster out of North Carolina. So I will be enjoying this and staying caffeinated this morning. If anyone else is enjoying a great cup, would love to hear about that as well. Okay, we are going to get started. As always, we are going to follow pretty similar format. If you joined us before, if you're popping on for the first time, this will be the framework for our day today. We start off looking at the economy and mortgage rates. And the reason we look at the economy is because that is what gives us insight into why mortgage rates are where they're at now and where they are headed in the future. Once we break down all of that, and there's a lot going on in the economy right now, but we'll get through that. Then we're going to go into real estate specific data. We start looking at the DMV data for the most recently reported month for Bright, which is August. Then we're going to go into the weekly data released in September. Then we're going to talk a little bit more about new administration policies, how they're affecting things. And we will close with our takeaways. Anything? I'll hang in there, Temi. Great to have you here. I appreciate you powering through. Anything you want to add before we get started?
I think that this is needed more than ever. I think every month that goes by, there's always something new that's happening. And so this is like amazingly needed, Paul.
Thank you. I appreciate that. So I'm just checking to make sure our Facebook and Instagram live streams are up. I think they are. Not seen on Facebook. All right, let's get started. Okay, where are mortgage rates out? I belatedly invited Mark Linkowitz, our lender partner with wonderful Envoy Mortgage. I'm hoping he's able to pop on, and I would love to hear what rates his clients have been locking at this week. But I I would also love to hear, and Maggie, thank you, would love to hear everyone on here. Like, we can look at the data that's been reported by Mortgage News Daily, and I'm about to talk about all of that. But it's also wonderful to hear what our clients are locking at in the real world, because all of those entities will have certain criteria that they use, which is a certain percentage down, certain credit score, debt to income ratio, all of that. And so it's really nice to hear with our clients with varying financial stability and qualifications what they are locking at in the real world. So please keep those numbers coming. Maggie is saying she got a client lock at 6.1, which is wonderful. Maggie, if you could drop in there, is that 30-year conventional FHA, VA? I assume that's got to be fee simple. I can't imagine a condo rate would be 6.1, but maybe.
I heard our lender say 5.75, but I'm thinking it's mostly. I'm thinking maybe it's VA, because I'm seeing more so when the rates dropped. Was it yesterday or 2 days ago? It was 6.1.
Mm-hmm.
But I've been getting some interesting emails from different lenders saying some things, and I'm just wondering how truthful they are.
Mm-hmm.
Yeah.
All right, so we will pop in these numbers are from, it was either early yesterday or the night before. So just know that it's interesting, and we'll talk about this in more detail. But after the Fed released their report and people learned about the contents of the meeting and the federal funds, well, everybody knows what happened, I'm sure, but won't spoiler alert. Once that news was released, mortgage rates actually went up just a little bit. Excuse me. So right now, Mortgage News Daily is reporting 6.22, but so that's a little bit above 3-year lows. But you can see here they are down in the low sixes, and we hit the lowest rates in 3 years. I mean, this is a pretty meaningful drop. Now, I've said for a while that I think we're not going to see massive buyer movement until that number starts with a 5, but still, like low sixes is like I said, when it hit that 6.1 level, that's basically the lowest level in 3 years. And as we all know, all of us have, the agents on here have so many buyers who are just sitting, waiting on the sidelines, waiting for rates to drop. And so I'm expecting, we saw this, we'll talk about this in the pending data for August, but we've already seen buyers start to jump back in. And so you can just see here the rundown that all of these numbers are down around 25 to 55 bips since we last met. And the 30-year is down basically half a point since last month. So that's real meaningful change. And just ballpark, roughly, it's not going to be this in every situation, but roughly a 1 percentage point drop in mortgage rates means 10% lower monthly costs for your buyers. So these are meaningful changes here. Okay, how are people feeling about the economy? Like how are people feeling? You know, if you have spouses, if you have partners and they work in other industries, how are they feeling about their jobs? Is anyone losing jobs? Your friends, your family, like how are they feeling? I'd love to hear that in the comments. And then while I'm waiting for those to trickle in, for anyone who's new joining us, I just want to ever so briefly run through why I spend all of this time on the economy. And like I said, it is because this is what sets the stage and establishes where mortgage rates are going to be at. It's not the federal funds rate. That's interconnected and related, but mortgage rates. How are mortgage rates arrived at? And this is overly simplified, but with enough detail to be helpful. You have the economy. The economy impacts the bond market. What is the economy? It's employment, it's inflation, retail sales, manufacturing output, industrial production. All of those things go into the economy and the GDP. And now we have, kind of more important than ever, tariffs and trade policy affecting that. Then we also have Federal Reserve policy, which is both affected by the economy and affects the economy. And the primary kind of levers they have to affect the economy are the federal funds rate, which is essentially the rate that banks borrow from each other overnight in order to meet minimum deposit requirements. And then they have quantitative tightening and quantitative easing. You can also hear this referred to as QT and QE. Essentially what that means is they either put money into the economy or pull money out. We had a lot of QE going on during the pandemic when they were buying billions and billions and billions and billions and billions of dollars of treasuries and mortgage-backed securities every single month, like massive portfolio of these assets. And that is why mortgage rates got so low during the pandemic, because you had the kind of the biggest dog on the block, which is the Federal Reserve, buying up just massive swaths of these securities, which meant that you could offer lower yields in order to sell those securities. So all of these things affect the bond market. Why does the bond market matter? Because mortgage-backed securities are part of the bond market. In short, a bond is a debt-backed instrument. It is something where, barring the insolvency of whatever's backing that up, you are going to get a guaranteed rate of return and your principal back. And so mortgage-backed securities are part of the bond market. And most mortgages are, when we talk about conforming mortgages, why does that matter? Because they are resold, and they are resold packaged into these MBS products and then sold in the bond market, where they have to compete with other bonds, US treasuries, and the like. And so they have to be competitive. The lower rate that can be offered for mortgage-backed securities and have those products sold, the lower mortgage rates can be given to the consumer. So in short, kind of a quick breakdown. That's why I covered the economy. That's why all this stuff is super important. Excuse me. Okay, so GDP, kind of the in sum, the TLDR of what's going on in the economy. The second estimate of Q2 2025 GDP was released at the end of last month. It was actually upwardly revised. When we last spoke, I gave you the advanced estimate of 3%. The second estimate came in at 3.3%. So that's a very strong rebound from Q1. You can see in Q1, we had a contraction of the economy. Things were slowing down. So things are moving in a different direction, but it's not super rosy. And I want to first, I'll talk about the Atlanta GDP. Federal Reserve of Atlanta has a GDP Now model, which projects the GDP for the next quarter. Right now, they have a Q3 2025 estimate GDP of 3.4, which is rosier than when we last met. When we last met, it was 2.3. But also want to note, the GDP Now model is always projecting a higher GDP than any other blue chip consensus. And you can see that here in the blue band. Kind of the blue chip consensus, the respected prognosticators, economists, market watchers who are projecting GDP for Q3 are coming in anywhere from a contraction to, maybe 1.75. GDP Now model is well above that. And I want to mention, I'll be shocked. And I guess we'll see. This is going to be saved on my YouTube channel where people can go back and watch whenever. And then we'll all be here again months into the future. So we'll see whether I'm right or not. But I would be absolutely shocked if we have a Q3 GDP of 3.4. I just don't see that happening. And a couple of reasons why is there are some indicators of softening in the economy. We're going to talk about the jobs market. Jobs market softening tremendously. And tariffs, trade policy, all of that stuff is putting extreme stress on businesses and the jobs market, and is kind of one of the primary drivers of that. But then beyond that, I always like to look under the hood at some kind of leading indicators. And two leading indicators, which might seem a little bit odd, but this is the kind of stuff you have to look for to just get nuggets about where this massive train known as the economy is headed. Two of the things that caught my eye are the lumber market and cardboard box industry. So right now, the lumber market, lumber prices have dropped 25% since the beginning of last month. And this drop would have, apologies about that again. So lumber prices have dropped 25% since the beginning of the last month. This drop would have been even greater, but the two largest lumber producers saw demand softening and have already pulled back output. And this might seem silly to touch on kind of lumber prices. The reason I'm doing that is it's important for two reasons. So one, dropping lumber prices are one of the best leading indicators of a slowdown in new construction. And so that just lumber prices dropping immediately should tell you new housing starts are going to be stagnated or most likely declining. And why would that happen when we've had a housing shortage in the United States for decades? Well, demand is softening in the housing market. So big. The Ty says nothing like Amazon shipping container to tell us where the market is headed. So that's the next one. So another leading indicator that I look at is cardboard box orders, the volume of empty packaging materials that's sold to retailers and distributors. And this is important because these cardboard boxes are sold to retailers and distributors who then use them to ship products to warehouses, stores, and to us. It's estimated that 75 to 80% of everything in stores is shipped in cardboard, and that many of those items themselves are packaged in cardboard. And consumer spending makes up 70% basically of the domestic economy. So cardboard orders hit their lowest second quarter numbers since 2015 recently. And cardboard manufacturing plants are reducing production levels to numbers we haven't seen since 2008. Anyone remember what happened in 2008? Was that a great time in our economy? No, it was not. It was a horrible time, particularly for the housing market. So it's like, these aren't great signs of where the economy is headed and where the housing market is headed. But I also want to add a little caveat proviso to this: is it's meaningful and we should pay attention to it. But I think it's at least partially explained. Like, let's just say if you took the combined what I just said about cardboard boxes and you gave that a score of 100. I'd say maybe 50 to 60 of that 100 is due to like real concerns about slowdown in the economy. But then 40 of that is due to businesses, and businesses are doing this across the board. And we're seeing this. This is part of what's happening in the employment picture. There's so much uncertainty right now with tariffs and trade policy that businesses are not able to make long-term decisions. And so to hedge their bets, they're basically holding off on making any decisions they don't have to make because they don't want to be locked into a poor position. This is happening with jobs, but employers are very, very slow to fill positions, and trickle down to cardboard boxes. So people that might normally stock up or place these larger orders are strengthening that. They're shortening their runway because they're not sure where demand's going to be. They're not sure where the industry is going to be. Okay. All right. Excuse me. Now we are going to pop on to inflation, CPI. The most recently reported numbers, we had a month-to-month increase of 0.4%. And then we had the 12 months, all items, at 2.9%. Water break, so I don't cough again. Okay, both of these didn't work. That's all right. We're all, getting that tea. Tea might have been more healthy than coffee, but I desperately need the caffeine. All right. Both of these numbers were in line with economists' expectations. But they're also both the highest numbers since the start of the year. No shocker. I mean, it's no shocker at all. Like, tariffs are making an impact on this, but then also it's not only tariffs, and we've been talking about this forever since before the most recent administration. A big basis for a lot of these increases has been shelter, and for the monthly change, shelter rose 0.4%, and it was the largest factor in the all items increase. Food and energy each rose over a half point, and they were also kind of massive contributors. But anyone know where this is headed? If you've been joining me, you definitely know where this is headed. How accurate is this data? I've been talking about this now for a few months because it's extremely important, and it's also it's important for you to understand. So I would say it's two steps. One, super, super important in our industry, for those of you who are agents, industry professionals, for us to understand the underlying data and what's happening in the economy and the real estate market. But then beyond that, it's also important for us to know how reliable that data is. If it's not, because if it's not reliable, then kind of who cares? Excuse me. And I've covered this before, so I'm going to go kind of super quick. But to come up with these CPI numbers, they basically have tons of price checkers looking for prices of things all throughout the country. Excuse me. And when they can't find prices on something, either if they can't find a specific item in a specific area, or they don't have a price checker in a certain area, And that's happened because there's been a hiring freeze at the BLS. They do what's called imputed cell imputation, different cell imputation, which is they either take the same item from a different geographic area and make an assumption as to what the price difference would be, or they take a similar item from the same area and then make that same assumption. What that basically means, when you see imputed cell imputation or different cell imputation related to CPI, it's guesses. It's educated guesses, but it's guesses. And the BLS, as with a lot of other departments in the federal government, they've had a hiring freeze since basically the start of the new administration. They have had a hiring freeze. They haven't been able to employ new price checkers. And as with anything, people retire, people quit, people are doged out, and they've lost about 20% of their price checkers over that time. They haven't been able to refill those positions. So as a result, here you can see this is a excuse me, bar chart of different cell imputation. And the light blue at the bottom is the different cell imputation, the guesses. And so these guesses usually make up, prior to recent months, these guesses never made up more than 10% of the prices. So you knew that 90% of the prices were based on actual prices and actual locations, concrete data, as specific and real as they could be. But in the past 5 months, guesses have made up 29% or more of these numbers. And last month, it reached a high of 36%. So more than a third of the information that goes into our inflation data, our CPI, when you see in Wall Street Journal, Bloomberg, whatever, talking about inflation is this, CPI is this, 1/3 of that is like, we think so. Yeah, I mean, that's our best guess. So I don't know. That's not as reliable as I would like it to be. Silver lining, there's still a hiring freeze of the Bureau of Labor Statistics, but they have been given an exemption to hire some part-time price checkers. I know it was reported there was something like a posting seeking to hire 24 new price checkers. And so we'll see what happens. First, they have to hire them and in sufficient numbers and not lose a large amount of the current. But I'm hoping this number goes down next month. All right, now popping into the jobs market. Oh, so like COVID diminished. I forgot to mention at the top of this, I love it when this is as interactive as possible. It's not as interactive as it used to be when we were on Zoom, when people could just speak up and kind of chime in. But we have that chat box. Feel free, drop comments in there, whether you're an agent, whether you're a lender, whether you're entitled, whether you're a consumer. Just throw your questions in there, because usually if you have a question or a concern, there are 10 other people or what do we have on here? Like 30 people right now live, and then we'll have, hundreds later watching. And so the odds are, if you have a question, at least a few dozen people who are going to be interacting with this will have that same question. Any thoughts you would like to add, Temi, all smiles of Koji, before we go into the jobs market, which is a downer?
No, right now this is just, it's always interesting. It's good that they're hiring at least part-time people. Yeah.
Yeah, and I'm always a little unsure of how much I should carry over from month to month for new people who are joining, because I don't want to bore the crew, especially the Fulcrum crew and those of you on here who have been with me for years now. But just super quick, the reason why this is even more troubling is United States markets have been able to outperform markets throughout the rest of the world because of the reliability of our data. Borrowing costs for money, the cost of doing business has always been lower here than in all of the rest of the developed world. And it allows for greater efficiency, greater wealth gain than you would have otherwise. And if uncertainty starts to creep into these numbers, you are going to have erosion of those efficiencies. And it's just going to increase the cost of everything. And that's basically, it's increasing the cost of inefficiency, which is something no one is able to capture. So not looking good, but at least, like I said, silver lining. Okay. So jobs report, 22,000 jobs were added last month. That was basically a third of what economists expected. Economists weren't, 75,000 jobs is much lower. You can look at the chart here, much lower than most months we've had over the last couple of years. But So it wasn't even like economists had high expectations, but they didn't even meet that. So 22,000 jobs added. More impactful than that, though, is the Bureau of Labor Statistics revised the preceding 12 months downward by almost 1 million jobs. Essentially, they said, okay, the total number of jobs we said were added over the last year, that number is actually half of what we thought it was. So it's like not only is the jobs market softer now, much, much softer than it has been, but it's also been much softer than we thought for a while. And just super quick, because like this is stuff that I've been paying attention to for a while, and most people have never heard of the Bureau of Labor Statistics or BLS and have no idea what they do, but it has been in the news a lot more lately. So now most people are at least aware of it. So just want to super quick, if you're not familiar with why these revisions take place, in an overly simplified kind of summary, the Bureau of Labor Statistics does surveys. They reach out to a bunch of businesses and are like, hey, are you hiring or firing? What's going on? How many jobs have you added? So they do these surveys. They try to collect as much data as they can, and then they release their monthly jobs report. But as time progresses, they are able to go back and look at local unemployment claims and tax records and all of this more concrete data that isn't available in real time or close to real time. And then they supplement what they got initially, and they do these revisions. So it's the same way when you look at GDP. There's the advanced estimate, the second estimate, the third estimate. And all that is there's so much data that's required to be collected to come up with these numbers that you can't do it. You can't give accurate, super accurate data of what's going on right now or what happened last month. So they give as accurate as they can. And then as more data comes in, they keep revising and keep revising. So that's why we have these downward revisions. All right. Now, the employment rate. The employment rate bumped up 0.1% to 4.3. And you might say, 4.3, whatever, Paul. Haven't you been talking about how the unemployment rate has been between 4 and 4.2 for the last 16 months or so? And that is true. Like 4, 4.2, 4.3 may not seem like that much of a difference. So it's only 0.1% outside of the range where we have been. But under the hood, it's a little more troubling, because if you add to that the number of people who are in part-time jobs who are actually looking for full-time, but can't get it, or the people who've been unemployed for so long, they've just given up. When you take that group, that number is 8.1%. So the true number of unemployed or underemployed is double this. It's almost 0.1% of the workforce. And this is the highest level in nearly 4 years. So this 4.3, even though it's 0.1% only bump above the band we've been, it's basically the highest number in 4 years. And when you look at the whole unemployed, underemployed, also highest number in 4 years. So there's no way you can sugarcoat this. There's no one who can intelligently speak about the employment market in any other way than it's the softest it has been in a while. And we'll that's why the Federal Reserve did what they did yesterday and Wednesday. Also want to note jobless claims. So another kind of one of the most recent pieces of concrete information you can get about the employment market. Jobless claims rose by 10% last week, and jobless claims are now at the highest level they've been at since October 2021. Okay, now Fed meeting happened yesterday and the day before. Anybody know what happened? Actually, I'm going to take this moment to look at the comments really quick. Going back to Maggie's question about how should agents communicate that uncertainty to clients who are asking about inflation and rates. I wouldn't spend too much time on it. I mean, clients aren't necessarily looking for this level of information. I have some clients who are economists, professors of economics, and they want this level of information, and I'll be happy to give it to them. For the most part, though, if I'm just talking to clients, they only care about mortgage rates. If they want to know a little bit more about what's happening and why mortgage rates are at, then I'll go into more detailed information. And if we do talk about inflation, then I'll just say, hey, just so you know, take those inflation numbers with a grain of salt, because there's a lot less certainty in the prices, and a third of them are guesses. So when you hear inflation numbers now, just take it as indicative of the ballpark range where they're at, and I think that's sufficient. Yeah, and Mark, our lender partner with Envoy, talked about how 10-year Treasury spiked after Powell spoke, and yeah, so federal funds rate dropped, and this is by the way, it's like by the time this happened, it was a surprise to no one. And Mark, I'd love to hear your thoughts on this. And by the way, anyone out there, please, if you don't agree with what I'm saying, I don't have an MBA like Virginia does, our resident wonderful principal broker. And this is just stuff I study all the time in excruciating detail. So I feel like I know it pretty well, and I'll put my knowledge up against pretty much anyone. But you could take the top 10 economists in the world, put them in a room, and they're all going to disagree. And so it's not like this stuff is gospel. I think I am giving you what, in my opinion, is kind of the most consensus view based upon the data. But if anyone disagrees with something it was something I'm saying, I would love to hear that. Okay, now going into the Federal Reserve. As expected, they dropped rates by a quarter point. They changed the Fed funds rate range down to 4 to 4.25. Jalil, yeah, so that's what they did. They dropped the rate. Now, this is there are a number of these Federal Open Market Committee meetings throughout the year where they also give a summary of economic projections, which is a more detailed look into what went into their decision-making process, and more importantly, where things are headed into the future. And then, as Mark mentioned, Chairman Powell also discusses it.
Also, shout out to Nastasia for getting it right.
Mm-hmm. Mm-hmm. Yeah, thank you. Love the contribution, love the interaction, love the comments. Thank you all. So this summary indicated that they expect 2 more rate cuts this year. There are 2 more meetings. If they're projecting 2 more rate cuts, that basically means they're projecting 1 in October, 1 in December. Not a sure thing, but right now that's what they're telling the market. And if the jobs market stays soft, that's likely to happen. And right now they're projecting another rate cut in 2026. But they made explicitly clear that they're not doing this. They didn't drop rates because inflation is under control, because it's not. As we just talked about, inflation is increasing. So they expect inflation to hit. They expect inflation now to hit 2.6% next year. This is up. In June, they projected 2.4%. They don't expect, the Federal Reserve does not expect inflation to hit their target rate, what they are aiming for, until 2028. So they're cutting rates, but even as they expect inflation to rise, and usually it's like when you think about the Federal Reserve and like what is the Federal Reserve obsessed with, and generally it's inflation. Stay to that 2% target rate. It's like the foundation of almost everything they do. But right now, they're considering the softening jobs market to be a little more important. And if you were a cynic, you could say that they also might have been influenced by some political pressure. I don't know if you've heard. There's some prominent named individuals out there who have been pushing for rate cuts for quite a while, and also people with those views who are now putting up people on the Federal Open Market Committee. So yeah, kind of interesting. Inflation not under control, expected to rise, but the Fed did the rate cut. Now, super quickly, why did the Federal Reserve lower the federal funds rate, but then mortgage rates popped up just a little bit? And a variety of reasons for that. And one, as I showed you before, and why I do the little chart, the federal funds rate does not determine mortgage rates. There's not a direct correlation. If you have a HELOC, if you have some credit cards, a variety of things that are tied to benchmark rates plus whatever, the federal funds rate can have a meaningful and fairly immediate impact, whatever it is, a 30-day cycle. Whenever that rate is reset, it can have a fairly immediate and direct impact on some of those products and some of those lending rates. Mortgages doesn't work that way. Like I said, it's the bond market. And the bond market, I mean, just think about like a lot of people with a lot of money doing everything they can to understand what is going to happen in the future. So by the time these decisions are made, they already know what they're going to be for the most part, and they have already included that in their calculus and their decision making. So the reason, in my opinion, and Mark and Virginia, I'd love to hear your thoughts on this if you agree or disagree. So the reason why mortgage rates popped up just a little bit is because of this, in this summary, what they talked about where they see inflation heading. And they don't see inflation as under control. They see inflation as rising. So even though the federal funds rate dropped, their outlook on the stability of the economy related to inflation is not as rosy. And super quick, someone's doing a pre-inspection on one of my listings and they're calling, which normally I would take regardless, but hey, we're live, so I'll have to catch them after the fact. All right, so think of bonds as like the safest port in a storm. And that is why you'll see money flow into the bond market when the economy is doing bad. If people are concerned about stock market returns and other investments, they'll just park their money in bonds because, like I said, it's a guaranteed rate of return. Their principal is safe unless the underlying entity goes bankrupt, goes out of business. That's why the 10-year treasury is kind of the gold standard, because up until recently, probably no one expected the federal government to go bankrupt, and we still don't. But anyways, so that's what the bond market is for. And usually it's a lower rate of return, and the trade-off there is you get stability. Now, when you think about these lower rates of return, the higher inflation is, the higher these rates of return needs to be for it to be a competitive product. You know, if inflation is 5% and you're looking at bond products with returns in the threes, I mean, you're essentially losing money. Now, sometimes that makes sense, but that's the TLDR of why mortgage rates popped up just a little bit after the remarks. It's because the market now expects inflation to be a little higher, which means you need to get a little bit higher yields on those products in order for it to make sense. And our resident experts are agreeing, so that makes me happy. Deserve a little more caffeine. All right, 10-year treasury. This is not accurate, by the way. Because like this 4.03 was before the summary was released before Chairman Powell spoke. So I know it's bumped up just a little bit. Well, I'll get you where it's at right now. My app is frozen. Thanks, Mark. Okay. Yep. 4.12. So as of right now, the 10-year treasury is at 4.12. Okay. All right. Now I'm going to jam through this because I want to spend a lot of time on the market. Okay. Retail sales up 0.6% from the previous month, 5% over a year. This exceeded market expectations. It was largely driven by back to school kind of shopping. So it's like times of the year where retail sales, you just have to take them with a little bit of, okay, is around the holidays and also now. So like back to school spending and holiday shopping can be a bit of wild cards. Industrial production and manufacturing, these industries have been relatively stagnant for quite a while. So industrial production increased after 0.1% after declining a bit in July. Manufacturing output rose by 0.2 in August after a 1% drop in July. Okay, now what is happening in the DMV real estate market? Sorry, I need to text this agent really quick.
I was going to say, yay. I think it's all our favorite part. What's happening in the DMV? Like, that's what I am, because it's just always, I feel like every month is different. I'm not sure if you guys are kind of feeling it. Like every quarter is different in this uncertain market. Every month is different in this uncertain market. So yeah, it's crazy. I will say I have about probably like quite a bit of listings coming up on the market this month, and a ton of people just looking to sell right now as rates are dropping. But I think someone asked me yesterday, is it because of job losses? Is it because of, this or that? Or do we even have enough buyers? I'm seeing showings pick up for like some of my listings, but I know, again, I always have to keep in mind, like what's happening to me may not be what's happening in this environment. I will say a lot of my clientele right now for the listings that I have coming on are estates and divorces. Those are the
Mhm.
two biggest. So I can't even say it's because of the the job market or because that's not what's impacting this, but it's other reasons. So it's just interesting.
Yeah, absolutely. And that was the sorry, COVID just completely spaced. I was keying in on something you were specifically saying, and then I got to what I was going to cover
Take your
next.
time, Paul.
And lost it. All right. Well, we're just gonna jam on. We're gotten a little behind. There's just so much going on in the economy that just spending a little bit more time on that, and it's important. But most of us are real estate agents, industry professionals, and it's important to talk about what's happening in the real estate market. And there's a lot that's happening, and there's a lot of uncertainty. So we're gonna unpack this. But honestly, like I'll talk about this in the takeaways. One of my key takeaways is like know your local market, because I'm going to talk about DMV wide and then we're going to break it down county wide. But if you could know verbatim off the top of your head all of the DMV wide stats, and that would not give you an accurate picture of where you're practicing if it's a more local area, because there's just so much variance in the various in the various markets right now. But want to go up 30,000 foot view. What's the market looking like right now? And it's looking very similar to how it's looked last month, the month before, the year before. Right now, we are on track for 49,476 units sold this year, almost identical pace to last year. Last year, we were 49,942. Year before, we were 48,950. So for the agents who have been in the business, or lenders been in the business for a while, this year looks like last year, looks like the year before in overall units sold, not in what is happening at a granular level, what is actually going on with our buyers and sellers. So you can see here, DMV wide median sales price increased by 2.1%. And that's 27th straight month now with median sales price appreciation in the market. So I said this before. People are talking about it's a buyer's market. The market is crashing. All of these things. Like, no, it's not. It's not. DC itself, DC has a softer real estate market. Everywhere else, still strong sellers market, still price appreciation. If 2.5 years ago you were a buyer and thought, yeah, I see what's happening, I'm just going to wait for prices to drop and I'm going to cash in. Well, all that's happened is you're paying more for your home than you would have then, and you've lost out on a lot of equity. But two things can be true at once. It can still be a strong seller's market in most of the area, and it can be softening, which is what's happening. You can see median days on market are up to 19, which is, yeah. Thanks, Ty. Yeah, market is definitely stable. I mean, we're seeing some shifts, but they're relatively slow and they make sense kind of for the most part. So days on market 19 over same time last year, which is an increase of 10 days. So properties are taking longer to sell. Now we look at closed sales and new pendings. These are both like almost right in line with where they were at same time last year. And they've been following this same band they have for quite a while. You can see the orange line is the line tracking this year, blue is last year, and then the gray band is the prior years. And you can see the closed sales new pendings were right along the bottom of the range we have been at for some time. Closed sales dropped by 2%, no shocker, because that's where pendings were last month. And pendings are up, which is what I would expect. The jobs report came out beginning of August. Employment market was much softer than expected. That caused an immediate drop in mortgage rates. Usually when you have a drop in mortgage rates, you have more buyers pop back on the fence. This is what I was going to comment on when you were talking, Temi, is that you're talking about, more sellers getting back in. That's absolutely true. I didn't say this specifically, but it is when there's a meaningful drop in mortgage rates, we should see more buyers come in off the sidelines and more sellers, because if you're selling a home, usually you need to buy somewhere else. And the reason why a lot of sellers are pushing off that decision is they don't want to pay more for a cheaper house if they're downsizing, because that's what would be happening if you're going from a 2.75 mortgage rate to, even now a 6.1, 6.2. And so drop in mortgage rates should lead to higher listings and higher buyer demand. All right, new listings, pretty close again to the level we were at last year, right at the lower end of where we have been at for the past 5 years. And this is like, I talk about this. I've been talking about this each month for a few months, but it's just because I'm still seeing stuff like this on social media and hearing people talk about as of people just fleeing the area, and all of these fired federal government employees are selling their places, and they're just all of these listings pouring on the market. And you look at that orange line, it's like, what? No, that's not happening. That's not happening. Listings are at the low end of where they've been at for the last 5 years, and they're basically even with where they've been at for the where they were at last year. So unless these are all renters, we're not seeing tons of people flee the area. Active inventory. So there is a meaningful change in active inventory, but this is what's been happening for quite some time now. We have 10,136 active listings. Just want to look at my notes here. At the end of July, we had 10,283. And at the end of June, it was right around the same. So active inventory DMV wide levels have been almost constant for the last few months. And this has been 19 straight months, though, of DMV wide increases in inventory over the same time the prior year. And this is another important thing to note. It's when, and I just hit on this because it's like understanding the data is important. Understanding what's causing the data is even more important, because that gives you a greater understanding of what's going on and where things are headed. And so I hit on these things because of that. So 19 straight months of DMV wide year over year increases of inventory. Why is that important? Because 19 months well preceded the current administration. It preceded Doge, preceded all of the tariffs and trade policy and stuff that's happening right now. So changes we are seeing in the real estate market, they may be partially influenced by what's happening with the federal government, and I'm certain they are, but that doesn't explain it all, because this stuff was in motion for quite some time. And then just want to note, we are still below, even with these 30 to 45% increases year over year in total inventory, we are still not at 2019 inventory levels. We're at about 85% of where we were in 2019, and 2019 is what I consider to be the last normal market. It was before the pandemic, before the Federal Reserve, QE, mortgage rates, all of that stuff. All right, this is just a breakdown of those numbers for when you get the deck. Now we are going to look a little more closely at county data. The median sales price breakdown and county data. So there's still upward pricing pressure in a lot of areas, but it's not consistent. The median price appreciation continues to be a little bit softer than it was outside of Arlington and DC. And Arlington's funny. Like, if you remember last year, Arlington had a big drop in median sales price. And then this month, they have a big increase in it. And it deals more, when you see Arlington numbers, it has to do more with the distribution of property types that have sold that month. And so I wouldn't take that at face value unless you look under the hood and really get to a granular level and figure out what's going on in Arlington. So don't take that as home prices just skyrocketing in Arlington, because it was the opposite last month. DC, I want to note, talked about this before, DC is showing some resilience in the market relative to others. They're a little more stable than some of the surrounding markets. But part of the reason for that is last year at this time, they were already a softer market. Okay, closed sales. And you can see this is all over the place. But we could have predicted this, because this is where new pendings were at last month. But up big in Alexandria, 19%. Closed sales up by 13% in Loudoun, up by 5% in DC, down by 15% in Frederick, and almost 18% in Prince George's County, even pretty much everywhere else. And this goes to the takeaway I was talking about. Like, you need to know what's happening locally, because we're not seeing consistency right now across geographic areas in the DMV. Okay, new pendings. So this is the most recent next to weekly data, kind of the most impactful of what's happening with buyer demand. Closed sales, a little bit of a lag, because they likely went under contract the month prior. And so new pendings, you can see that they're close to even in Frederick. Frederick has shown a little bit of a rebound from last month in the first week of August. So closed pendings are down just a little bit in DC. Prince George's County continues to show a slowdown in buyer demand. And we'll see this in the showing level too. Up everywhere else, Arlington and Alexandria, particularly hot. So important to note, this is changing in September. DC is even slower. DC is really taking a hit in pendings and showings so far in September. Maryland is slowing. Montgomery County and Prince George's is slowing in September. But Nova remains strong. Alexandria and Arlington are strong, continuing into this month. Days on market, as you saw in the DMV wide, days on market jumped up. Like I said, there are 19 days DMV wide, up 10 days from same time last year. And this is happening. This is the one of the main consistent things. There are two things that are pretty much consistent across all areas in the DMV. And that is active inventory higher than it was last year, and days on market higher than it was last year. And so right now you have 2 weeks or more, pretty much every area, with a lot of areas seeing a bump over what their days on market were same time last year. So for quite some time, we've been able to say half of all properties in the area have gone under contract in 2 weeks or less. Now that's looking a little more like half of all properties in the area are going under contract in 3 weeks or less. So that trend is continuing into September. By the way, we're seeing DMV wide right now. The September numbers I've seen, well, when we get to it, I think it was 33 days. And it's uncommon. If you look at the monthly data going back years, it is rare to have a month with median days on market for the DMV at 30 or higher. And all of those months were in the winter.
Hey,
DC,
Paul.
Yep, just DC highest days on market by a fair margin, and that's been the case for quite some time. Go Temmie, all smiles.
And maybe this could be a discussion for like after we're done. But what would be like your advice, or if you were giving advice for agents right now, seeing that homes are staying on the market a little bit longer? What do you have any thoughts or advice for agents, and just even specifically Prince George County, seeing like we have the inventory, but pendings are going down and things like that. So not sure if you have any ideas or advice or thoughts on that.
Yeah, and great question. It's more important than ever to understand what's happening in the area where your listing is going live. So I would say if I have a listing that's coming up, or even if I'm meeting with a client for the first time, because you're setting expectations at the first meeting and you don't want to say a bunch of things to get the listing that aren't true and then disappoint them later. And so it's always super, super important to give accurate information from the get-go. But what I would say is I would want to know, if I have a listing coming up or a listing appointment, I would want to know median days on market, average days on market for that immediate area in that price point and that type of property, whether it be detached, whether it be row home, whether it be condo. And then I would also want to know the median and average sales price to list price ratio. And that, I'd want to know other things as well, and where new pendings are at and all of this stuff, and median price appreciation and all of that. But if I just had days on market for the property type in the general area, and if I had sales price to list price ratio, then I could set expectations properly. And so then take that aside for a moment. Always the most important thing with the listing is to price it appropriately. Now, even more important than ever, because the tale between the haves and the have-nots with success in listings is getting a little more stark. So it's like, make sure you price it right to begin with. And then if you understand what's happening in the market, you'll know how to react. So if the median days on market, average days on market, let's just say they're the same thing, make things easier. Median and average days on market for an area are 4 weeks. Then if you're 2 weeks into your listing and you haven't gotten an offer, probably not time to panic. Probably not time for a price adjustment. Now, if you've had 0 showings, then maybe. But if you're having decent showing activity, then maybe it's not time for a price adjustment. And that's kind of the most important thing, is to understand. We've gotten so used to a lot of areas hit the market on a Thursday, go under contract on a Tuesday, that if you end up, you've been on the market for a week, then sellers are starting to panic. So you need to set those expectations, and no better way to do that than to understand what is happening in your market and what is quote unquote normal. All right, you're going to jump in months of supply. I've been saying this for a while now, but it's still the same thing. And this is why outside of DC, we are not in a buyer's market. Outside of DC, we're not in a buyer's market. And you can see this because there's no meaningful inventory anywhere in the core DMV except the District of Columbia. DC is just under 5 months of inventory. They've been in this range for quite some time. Depends on where you like to call that range. Some people say that's equilibrium. Some people say that's an even market. Some people would say that's creeping into buyer's market territory. Also want to note, because this is important, like when markets are changing, it can happen relatively quickly. And this is August, so it's a little bit dated. I pulled all of this data manually yesterday, and it's a rough approximation because I didn't go into all of the levels and steps to really get a refined months of inventory. So just consider this a ballpark. But as of yesterday, there was less than 2 months of inventory in Alexandria, Fairfax, Loudoun, and Montgomery, and Frederick, a bit over 2 months in Arlington and Prince George's, and DC was a little over 5 months. So it's still objectively, county-wise, across all property types, we are still in a relatively strong seller's market. And I know some people are going to say, no, we're not, Paul. I listed last year and all my listings went under contract in 2 days, and now they're taking 9 days. It's like, just because things are taking longer than they were last year, or just because properties aren't selling for quite as much, doesn't mean it's not a seller's market. It's just we've been in an extreme seller's market for so long that now just like a strong seller's market seems weak by comparison, but it is not. Okay, new listings. Overall, new listings are down DMV wide. So again, people fleeing the area, everyone just throwing their houses up for sale, and this glut of inventory on the market. New listings down DMV wide by a fair amount, 6.5%. Arlington basically, they're up 6.5% in Arlington, down about 2 and change DMV wide. They are basically even in Alexandria, Fairfax, Frederick down 2% and change in Loudoun and Montgomery County, down 4.3%, Prince George's. And new listings are down almost 10% in DC. Kind of interesting. So all of these federal government employees dumping their properties in DC, it's just still not happening. We're seeing, like I said, last month, new listings down by 10% in DC. It's changing a little bit in September. We have seen new listings up by about 7% in DC over the first 2 weeks of September. So that's something I'll talk about in key takeaways. If you are a seller in DC right now, just be extremely careful and make sure you have an amazing agent. And if you're an agent counseling clients listed in DC right now, be just make sure you know your stuff and you are making informed decisions all the way out, because we are seeing a little bit of an uptick in inventory, and we're seeing buyer demand really soften into September. Basically, since the National Guard was deployed in DC, we have seen almost immediately, a fairly sharp decline in new pendings and showing levels. So who knows how that will all play out, but whenever you have an increase in new listings and a decrease in buyer demand, that makes it tougher to sell a property. Okay, active listings up everywhere, but take these year-over-year numbers with a grain of salt, because it's like still last year at this time, all these areas had virtually no inventory. So an increase of 50% of nothing is nothing. An increase of 100% of nothing is nothing. But everywhere is up about 40 to 65%, except DC, which is only up 17%. All right, showing level. And this showing level would to be expected. Mortgage rates dropped in August. Expect showing levels to kind of tip up. This is something covering this month. Bright shared some really interesting data they pulled from IRS returns. And this is something we all kind of knew. I mean, I knew from DC-wide population data that they took a hit in population in 2020, and it hasn't been the same since. But this in Bright, they looked at migration flows by tracking tax returns. And it's interesting. You look at these counties. So that's the district right there. That's Arlington, Alexandria, Montgomery County, Prince George's. So this is DMV wide. Look at all of those counties. And so we're talking about Spotsylvania, Stafford, Fauquier, Prince William, Loudoun, Fairfax, Arlington, Alexandria, Montgomery, Frederick, Carroll, Howard, Baltimore, City and County, Hartford, Anne Arundel, Calvert, Prince George's, St. Mary's, and Charles. Out of those counties, over 2021 and 2022, the district lost people to all of those counties they had a net migration, a net outflow, more people going there than coming into DC for every single one of those counties except Harford. That's the county northeast of Baltimore, over here, I think. And Harford, there was a net movement of 3 people into the district. So just let that sink in for a minute. 2021 to 2022, DC lost population to every other area in the DMV. All right, weekly snapshot. So we saw the boost in August because of lower interest rates. I thought that would continue into September, but we're seeing some buyers slow down. We're seeing a decline in showings and pendings and a continued jump in days on market. So just keep that in mind. Still strong sellers market in a lot of areas, but we are seeing buyer slowdown, and we're seeing a more sustained increase in new listings, up around 8% overall for the wider DMV so far in September. And then I talked about these days on market, how it's unusual to have a median days on market for the month at 30 or above. Don't know if this is going to hold, but January of 2018 was the last time we had a month with median days on market at 33. And mentioned this last month, there have only been 5 months in the past 10 years where median days on market for the DMV was above 30. And all of those months were December to February. So in the winter. So we still have really low inventory. Like I mentioned, more than half of all homes, more than half around there, have been going under contract about 3 weeks or less. There remains a lot of upward pricing pressure in a lot of these areas, but things are changing and softening. And you can look here, canceled listings up by almost 40% over the same time a year ago. And a week is a small snapshot, kind of small snapshot. You need more data to really rely on it. But what we're seeing is indicative of, like I said, slowing buyer demand. Okay. New administration policies affecting real estate. We kind of already talked about this in a lot of different ways, and we are over. So I'm just going to pop ahead. Key takeaways. And these have been fairly similar because our environment has been fairly similar. There are things changing at the granular level, but what that means to us, and by us, I mean any, agents, consumers, buyers, sellers, investors, is pretty similar. And number one, it's more important than ever. If you're a consumer thinking of making a real estate move, or you need to make a real estate move, you need to buy, need to sell, maybe thinking of investing, more important than ever to rely on expertise with your professionals, great agents, great lenders. It is just super important because of where things are changing, and you need to make sure your conception of the market matches the current reality. And then for agents, like if they're relying on us, then we better know our stuff. And as you saw when I did the county breakdown, having a local level of information, always super important, but now even more important than ever, because if you just understand DMV-wide data, that isn't necessarily going to let you know what is happening in your area. In many ways, so takeaway number 2, in many ways, it's the best time to buy in a while. Yeah, we've seen price appreciation. You're going to pay a little more for your home than you would have last year or the year before. But DMV prices have continued to rise. The expectation is we're going to see that. It's tapering off just a little bit. So waiting could still mean paying more, but mortgage rates are near their 3-year lows right now. So you can get a decent rate, and then you can also refi when most of us expect sometime in the next couple of years, rates come down a little more meaningful. So sellers, I wanted to break up the takeaways into 2 parts because the district is very different from a lot of the surrounding areas. And so sellers, part 1, outside of DC, sellers still have the advantage. Most of the DMV remains in a seller's market. If you are a seller outside of DC, you still have the advantage, but the market is showing signs of softening. It's like now is a great time to maximize your home's value if you would need to sell anytime in the next year or 2, but just make sure you price it right, because if you don't, buyers out there are very educated and your home will sit, and there's no sure way to get a poorer result for a listing than to overprice it to begin with. Now, takeaway sellers part 2 is for sellers in DC. And if you're a seller in DC right now, I would just say, just be very careful, very cautious. Make sure you understand the market and what is happening. Like I said, since the National Guard deployment, new listings are increasing, but pendings and showings have dropped. And so I don't know if this is just a temporary thing of buyers being scared off by a strong military and police presence, or if this will continue. And I mean, no one really knows. It's just anyone's guess. So I can't tell you what will happen related to this, because they might get pulled out, things might return to normal. But as it stands now, the impact is a decrease in buyer demand. So just be aware of that. All right. We have reached the conclusion, 5 minutes over. I'll blame that on, I think I spent 5 minutes coughing and sniffling. So that's not my fault. We'll put that on the COVID. If you have any questions or comments, feel free to reach out. As always, like, if you like this, go on my YouTube channel, hit like, subscribe, all the usual stuff. Feel free to email me with the deck. Any closing thoughts? Temi, all smiles, Koji.
Absolutely love this. Can you hear me?
Mm-hmm. Your video's frozen, but I can hear your audio.
Did you guys lose me?
No, I can hear you. I can hear you. I can hear your audio. Just video's frozen.
Sorry. Not sure what happened. Okay. So my video, maybe that'll be helpful. No, really good information. I think the more we know what's going on in our direct area, the better it is before we take our listings. The easier it is to communicate to our clients. So this is incredibly helpful. And I have some ideas. I always have ideas coming through this, but I have some more ideas after this. So this is great.
Nice. Thank you, Temi. And thank you for your contribution, for powering through, even though you're a little under the weather. And thanks for everyone who's joining. Just love the comments, love the input. It's so valuable, like that boots on the ground type of, or like, you know, with Mark, where his clients have been locking at in the past week, or Maggie chiming in, and then Virginia giving us kind of broker-wide perspective. All super, super helpful, super informative. So love you guys. Maybe I'm feeling a little overly emotional in these challenging illness times, but I really do appreciate you all and enjoy doing this every month. So thank you for joining. Thank you, Temi. Take care, everyone, and we will catch you next month.
Thank you, guys.